Other types. Remember, a signal bar is a setup bar that led to an entry. However, not all trades are worth taking, and just because a stop was triggered and turned the prior bar into a signal bar, that does not make the trade worth taking. For example, many signals in a tight trading range, which is described later, are best avoided. All signal bars are meaningless in the absence of price action that indicates that the breakout of the bar will likely go far enough for at least a profitable scalp. Strong trend bar. A very important signal bar is a strong trend bar, especially during the spike phase of a trend. For example, if the market just broke above a bottom at an area of major support on a major news item that will affect the market for days, traders will look for any reason to get long. One common approach is to wait for a bar to close, and if the bar is a strong bull trend bar, traders will buy at the market as soon as the bar closes. Many will try to quickly place a limit order at the price of the close, and if their order is not filled within a few seconds, they will change it to a market order. Other traders will enter on a stop at one tick above the high of the bar. This urgency results in a series of bull trend bars and an increasingly larger bull spike. Reversal patterns. Traders are always looking for a change of direction, and they rely on reversal patterns as the earliest sign that a change might be taking place. The risk is to the 101, 102 price action. End of the bar, and the reward is often several times greater. For example, if a trader buys on a stop at one tick above a bull reversal bar that is 8 ticks tall, he might put a protective stop at one tick below the bar, and the total risk would then be 10 ticks. However, the trader might be planning on taking profits at 20 or more ticks above the entry. When there is a strong trend that might be reversing into a trading range or into an opposite trend, traders will want a strong reversal setup, which is often simply called a reversal. This is because trends are resistant to change, and if traders are to bet on a move in the opposite direction, they will want a strong sign that the market is about to reverse. However, if there is a strong trend and then a pullback, traders are so confident that the trend will resume that they will not require a strong reversal setup at the end of the pullback. In fact, the majority of signal bars for trend pullback trades look weak. If a pullback setup looks perfect and easy, it usually means that the trend is not strong. So many traders would take it that it often becomes the final flag in their trend, leading to a bigger correction. Trends require traders to keep missing entries, so there is a constant tension, a constant desire to get in, and one of the ways that trends accomplish this is through weak signal bars. For example, if there is a two-legged pullback to the moving average in a strong bull trend, traders might be willing to buy above the high of the prior bar even if it is a bear trend bar and not a strong bull reversal bar. They are afraid that the pullback will reverse back into the direction of the bull trend and the rally might quickly accelerate. They wanted a pullback so they could buy at a lower price, and now that they have one, they want to be sure that they buy before the breakout from the bull flag goes very far. All traders have this sense of urgency, which is why the rally to a new high is often very fast. Traders who did not take the trade because the signal looked weak will remain eager to buy, and many will keep buying in small pieces all the way up, just to be certain that they have at least a small position. Trapped shorts keep waiting for a deeper correction and a clearer buy signal to let them out with a smaller loss, but one never comes and they have to keep buying back their shorts in pieces as the trend continues higher. Most trends eventually have at least a minor climax before a deeper correction comes, and the climax is usually due to the weak traders finally entering late and the last traders on the wrong side finally exiting. When no traders are left on the wrong side, the sense of urgency disappears and the market usually enters a trading range, at least for a while. Besides a classic reversal bar, other common reversal setups, some are 2 or 3 bar patterns, include the following. 2-bar reversal. 2-bar reversals are one of the most common reversal setups and therefore are very important. It is useful to think of every reversal as a type of 2-bar reversal. Signal bars. Other types. 103. Because the phrase reminds traders that the market made a strong move in one direction and then a strong move in the opposite direction. The strongest moves usually begin with either a reversal bar or a 2-bar reversal for the signal. This is why it is so important to be ready to place a trade when the setup occurs at a time when a strong move might follow. 2-bar reversals have many variations and are a part of every reversal, but they may not be apparent on the chart you are using. However, as long as you understand that the market is reversing, it is not necessary to look at many types of charts to find a perfect 2-bar reversal or a perfect reversal bar, although they both are present in every reversal. The best known version is a pair of consecutive 5-minute trend bars of approximately the same size but opposite directions. A long setup is a bear trend bar immediately followed by a bull trend bar, and a bear setup is a bull trend bar immediately followed by a bear trend bar. These two bars create a 10-minute reversal bar, but the reversal bar is evident on the 10-minute chart only 50% of the time because only half of the 5-minute 2-bar reversals will end at the same time as the 10-minute bar. The other half will result in some other usually less clear reversal on the 10-minute chart. It is important to realize that all climactic reversals, all reversal bars, and all 2-bar reversals are exactly the same and all are present at all reversals, and you will be able to see them if you look at enough different types of charts. If you think about it, even a classic reversal bar is actually a 2-bar reversal on some smaller time frame or on some other type of chart, like a tick or volume chart that uses the right number of ticks or shares per bar. Also, the 2 bars in opposite directions do not have to be consecutive, and most of the time they are not. However, if you look at all possible higher time frame charts, you will be able to find one where the setup actually is a perfect 2-bar reversal. You can almost always find one where it becomes a single reversal bar. Always be open to all possibilities because you will then find many more setups that you understand and have confidence to trade. The key is to recognize that a reversal is taking place, and you need to be aware of the many ways that it can appear. A bear reversal always has a bull trend bar, which is acting as a buy climax, followed before long by a bear trend bar, which is acting as a breakout to the downside. A bull reversal is the opposite, with a bear trend bar that is acting as a sell climax and then a bull trend bar that is acting as a bull breakout. A reversal bar can be the second bar of a 2-bar reversal. When it overlaps more than about 75% of the prior bar, it is better to regard the 2 bars as a 2-bar reversal setup rather than as a reversal bar. If you do so, the odds of a successful reversal trade are higher. For example, if the market is rallying and forms a bear reversal bar with a low that is 1 tick above the low of the prior bar, this is often a bear trap. The market frequently falls 1 tick below the bear reversal bar but not below the bull trend bar that preceded it, and then rallies to a new high. 104. Price action. Within a couple of bars. This happens much less often if that bear entry bar falls below the low of both bars and just below the low of the bear reversal bar. When the reversal bar overlaps the prior bar by too much, they form a 2-bar trading range and the breakout entry is beyond the entire trading range. Since the trading range is only 2 bars long, the entry is beyond both bars, not just the second bar. If that bear reversal bar falls below the prior bull trend bar, treat it like an outside bar, even if its high is below the high of the bull trend bar. In general, it is then better to wait for a pullback to a lower high before going short. Otherwise you are shorting so far below the top of the bull leg that there is too much risk that you might be shorting at some support level, like the bottom of a developing trading range, and the market might rally. There is a special type of 2-bar reversal that signals a trade in the opposite direction. If there is a 2-bar reversal that is sitting on or touching the bottom of the moving average and the 2 bars almost entirely overlap one or more prior bars, the breakout usually fails. If the market is in a strong trend, however, the signal will usually work, since almost any with trend entry works in a strong trend. When there is not a strong trend, the signal usually fails even if there is a perfect 2-bar reversal. Any 3 or more large, overlapping bars will do. For example, if there is a 2-bar bull reversal just above the moving average and the bars are relatively large and mostly overlap a 3rd or 4th bar, do not buy above the high of the signal bar. The market has formed a small trading range, and traders who are confident in their read of the overall price action can often short the market at or above the bull signal bar for a scalp down. 3-bar reversals. A 3-bar reversal is just a variation of a 2-bar reversal where there are 3 consecutive bars, with the first and third being the bars of a 2-bar reversal and the middle bar being an unremarkable bar, like a small bar or a doji. This creates a 15-minute reversal bar when the third 5-minute bar closes at the same time as the 15-minute bar. When that happens, it is likely more reliable because it would then bring in traders who are trading off of 15-minute charts. In Thetuto 3 times that it does not, the 5-minute signal usually results in some other 15-minute reversal pattern. When looking for any 5-minute reversal entry, it is helpful to think about whether there are 3 consecutive bars that might also be forming a 15-minute reversal bar. If so, this should give you more confidence in your trade since a higher time frame signal is more likely to be followed by a larger move, and you might be more comfortable swinging more if your position and using a wider profit target. In general, traders should view them as simple 2-bar reversals and not worry about whether they are also creating a 15-minute reversal bar. Signal bars, other types. 105. Small bars. A bar that has ASML range compared to the prior bars can be a reversal signal bar. Here are common examples. An inside bar, which is a bar with a high below the high of the prior bar and a low at or above the low of the prior bar, or a low above the low of the prior bar and a high at or below the high of the prior bar. It is more reliable if it is small and has a body in the opposite direction of the current trend and less reliable if it is a large doji bar. In fact, a large doji is rarely a good signal bar even if it is an inside bar, and since it is a 1-bar trading range, it is usually followed by more 2-sided trading. An E or E pattern, which is 2 consecutive inside bars with the second being inside of the first. An E is made of 3 consecutive inside bars. A small bar near the high or low for big bar trend bar outside bar or trading range, especially if its body is in the direction of your trade, indicating that your side has taken control. An EOI pattern, which is an inside bar followed by an outside bar and then another inside bar, inside outside inside. If it occurs in an area where a breakout seems likely, traders can enter on the breakout of that second inside bar. These are often breakout mode setups, meaning that the move can be in either direction, and it is often prudent to place a sell stop below and a buy stop above that second inside bar and enter in the direction of the breakout. The unfilled order then becomes the protective stop. Note that doji bars are rarely good signal bars because they are 1-bar trading ranges, and when the market is in a trading range, you should not be looking to buy above the high or go short below the low. They can be decent signal bars for reversal trades if they occur near the high or low of a trading range day, or if they are with trend setup in a strong trend. In a trading range, it can be fine to sell below a doji if the doji is at the high of the range, especially if it is a second entry. The bigger trading range trumps the tiny trading range represented by the doji bar, so selling below the doji bar is also selling at the top of a large trading range, which is usually a good trade. Outside bar. An outside bar is a bar with either its high or its low beyond that of the prior bar and the other extreme of the outside bar at or beyond the prior bar's extreme. See Chapter 7. 106. Price action. Micro double bottom. A micro double bottom is consecutive or nearly consecutive bars with identical or nearly identical lows. When it forms in a bear spike and it is a bear trend bar closing on or near its low and then a bull trend bar opening on or near its low, it is a own bar bear flag. If the lows are identical, consider selling at 1 tick below the low. At all other times, it is more likely a reversal pattern, since most small bull reversals come from some type of micro double bottom discussed in Book 3. Micro double top. A micro double top is consecutive or nearly consecutive bars with identical or nearly identical highs. When it forms in a bull spike and it is a bull trend bar closing on or near its high and then a bear trend bar opening on or near its high, it is a 1-bar bull flag. If the highs are identical, consider buying at 1 tick above the high. At all other times, it is more likely a reversal pattern, since most small bear reversals come from some type of micro double top discussed in Book 3. Reversal bar failure. A reversal bar failure is the bar after a reversal bar that breaks out of the wrong side of the reversal, e.g., if there is a bear reversal bar in a bull trend and the next bar trades above its high instead of below its low. Shaved bar. A shaved bar has no tail at one or both of its extremes. It is a setup only when it forms in a strong trend, e.g., in a strong bull trend. If there is a bull trend bar with no tail on its top or bottom, then it is a buy setup. Exhaustion bar. An unusually large trend bar in the direction of the trend can often represent an emotional exhaustion of a trend. All trend bars are spikes, breakouts, gaps, and climaxes are exhaustion bars, and sometimes the exhaustive component can be the dominant feature. Trend bars. Besides being signal bars for with trend entries in strong trends, trend bars can also be signal bars for reversal trades, like a pullback reversing back in the direction of. Signal bars. Other types. 107. The trend, and for reversal trades in trading ranges. For example, if there is a strong bull trend and at least 20 consecutive bars have been above the moving average, and the market drifts sideways to the rising moving average, look to buy the close of the first small bear trend bar with a close that is only a tick or two below the moving average. Also, look to buy above its high. You are expecting the sideways to down correction to end and reverse back into the direction of the trend. If there is a clearly defined trading range with multiple reversals and there is a two-legged, two-bull trend bar spike to a slightly new high in the middle of the day, this is often a good signal to go short at the market, especially if you can scale in higher and especially if it is a part of another pattern, like if it is at the top of a small wedge or if it is a test of a bear trend line. Also, if there is a two-legged sell-off in the trading range that forms a bear trend bar that closes below an earlier swing low in the trading range in the bottom half of the range, this can also be a signal to buy at the market, especially if you can add on lower or if it is part of another pattern, like the bottom of a wedge bull flag. All bars in a channel. When there is a strong bull channel, bulls will place limit orders to buy at or below the low of the prior bar, and bears will place limit orders to short at or above the high of every bar and above every swing high. Bulls will also place buy stop orders above the highs of pullback bars, and the bears will place sell stop orders below the lows of bars at the top of the channel. The opposite is true in a bear channel. There are many types of small bars and many different situations in which they occur, and all represent a lack of enthusiasm from both the bulls and the bears. Each has to be evaluated in context. A small bar is a much better setup if it has a body in the direction of your trade, a small reversal bar indicating that your side owns the bar. If the small bar has no body, it is usually better to wait for a second entry since the probability of a successful trade is much less and the chance of a whipsaw is too great. An inside bar does not have to be totally inside, high below the prior bar's high, low above the prior bar's low. One or both of its extremes can be identical to that of the prior bar. In general, it forms a more reliable signal when it is a small bar and when its close is in the direction of the trade you want to take. It is always better to have bull signal bars when you are looking to buy and bear signal bars when you are looking to sell. When an inside bar occurs after a big trend bar that breaks out of a trading range, it could be simply a pause by the trend traders, but it could also be a loss of conviction that will lead to a reversal, failed breakout. A reversal is more likely. 108. Price action. When the small bar is an inside bar and it is a trend bar in the opposite direction of the large breakout bar. A with trend inside bar increases the chances that the breakout move will continue, especially if the market had been trending in that direction earlier in the day, for example, if this might be the start of the second leg that you were expecting. Small inside bars after breakout trend bars are somewhat emotional for traders because they will consider entering in either direction on a stop and will have to process a lot of information quickly. For example, if there is a bull breakout during a down day, the trader will often place an order to buy at one tick above the high of the inside bar and a second order to sell at one tick below its low. Once one order is filled, the other order becomes the protective stop. If the order was filled on a breakout failure, i.e., on the sell order, the trader should consider doubling the size of the buy stop order. In case the failed breakout becomes a breakout pullback, opposite failures means that both the bulls and the bears were trapped, and this usually sets up a reliable trade. However, if the trader was first filled on the buy with trend order, he usually should not reverse on the protective stop, but might if the day had been a bear trend day. Once there has been a second or third bar without a failure that then occurs has a higher chance of simply setting up a breakout pullback entry in the direction of the new trend rather than a tradable failure. In general, good traders make quick, subjective decisions based on many subtle factors, and if the process feels too confusing or emotional, it is better to not place an order, especially complicated orders like a pair of breakout orders or an order to reverse. Traders should not invest too much emotion in a confusing trade because they will likely be less ready to take a clear trade that may soon follow. An inside bar after a swing move might mark the end of the swing, especially if its close is against the trend and other factors are in play, like a trend line or trend channel line overshoot, an ABC two-legged correction, a high or low 2, or a new swing high in a trading range. Also, any small bar, whether or not it is an inside bar, near an extreme of any large bar, trend bar, doji, or outside bar, can set up a reversal, especially if the small bar is a small reversal bar. In general, traders should be looking to buy low and sell high. In a trading range day or a trading range in a trend day, the only small bar entries should be fades at the extremes. For example, if a small bar is a swing high, or follows a bear trend line test or a bull trend channel line overshoot and reversal, only look for a short entry. If it is a swing low, only look for a buy. In a trend even one during a trading range day, a small bar can set up an entry in either direction. For example, if there is a strong bull move and no prior break of a significant bull trend line, an inside bar near the high of a large bull trend bar or a small bar that extends above the high of the trend bar should only be viewed as a buy setup. If it is an inside bar, especially if it is a bull trend bar, it is a great long setup. If it is simply a small bar that extends above the high of the bull trend bar, it might be a safe long setup if the trend is strong enough. In general, it would. Signal bars, other types. 109. To wait for a pullback, unless the small bar is a bear reversal bar, in which case it could trap bears and it might make sense to buy on a stop at one tick above its high. An E pattern is an inside bar that follows a larger inside bar. It is two in a row with the second being inside the first and of the same size or smaller. An E is even stronger, with three in a row. After a protracted move, especially if there has been a trend line break, a with trend breakout from an E pattern is often just a scalp and has a good chance of reversing before or after the profit target is reached, a final F flag, as described in Book 3. However, a counter-trend breakout or a reversal from a final flag often leads to a large reversal. The pattern often develops in a final flag because it finally indicates balance between the bulls and the bears. The strength of the weaker side has caught up to that of the stronger side, at least temporarily. As such, if the with trend side takes control, the odds are high that the counter-trend side will try to take it back after the with trend breakout. The stop on an E pattern is beyond the opposite side of both bars, not just the second bar, which technically is the signal bar, but sometimes you can use a smaller stop beyond the second of the two bars instead of beyond both bars if the bars are relatively large. After the entry bar closes, tighten the stop and consider reversing at one tick beyond the entry bar. Keep looking to reverse on any failure in the next several bars since failures are common soon after E breakouts, especially if the pattern forms in the middle of the day's range. A 5-minute E pattern is often a 1-minute double bottom pullback in a bull trend or a double top pullback in a bear trend described in Book 2, which are reversal patterns and might explain why a small E can lead to a large counter-trend move. When there is a strong bull trend, there will sometimes be two consecutive bars with identical highs, and usually with small tails at the tops of the two bars. This is a 2-bar double top buy setup and is a double top on the 1-minute chart. Place a stop to go long at 1 tick above the high of the bars because you will be buying a failed double top and there will be protective stops there from traders who shorted it, adding fuel to the move. Likewise, in a strong bear trend, look to short on a stop at 1 tick below a 2-bar double bottom sell setup. 2-bar reversal setups go by several names, and each is an overlapping pair of trend bars with opposite directions and bodies of about the same size. In a 2-bar reversal top setup, the first bar is a bull trend bar and the second is a bear trend bar, and this combination is a sell setup if the market is not in a trading range. A 2-bar reversal bottom is a bear trend bar and then a bull trend bar and forms a buy setup. They are each basically a 2-bar reversal pattern and they correspond to a 10-minute reversal bar. Just imagine how the two 5-minute bars would look when combined into a single 10-minute bar. A 2-bar reversal can be a continuation pattern, a 1-bar flag, or a reversal pattern, depending on the context. For example, if the market is in a strong bear spike and then has Abhirbaran then a small bull trend bar with allothatis close. 110. Price action. To the low of the bar before it, this is a 2-bar reversal. However, since the market is in a steep trend, you should never look to buy above it. Instead, you should view the bull bar as a 1-bar bear flag and consider shorting below it. In contrast, if the identical 2-bar pattern formed in a bull trend at the end of a 2-legged pullback to the moving average, this is a 2-bar reversal and a good setup for a buy setup. The pullback is ending and reversing back into the bull trend. When a trend bar in a strong trend has a shaved body, no tail at one or both ends, it usually indicates that the market is one-sided and strong. However, a shaved top on a 5-minute bull trend bar in a runaway bull trend is stronger than a shaved bottom, because the extreme strength is right into the close of the bar and it is more likely to continue the strength that occurred 5 minutes earlier. Therefore, a shaved top is a good setup for a long. If the bar has a 1-tick tail at its high or a shaved bottom, it is still strong, but in general that alone would not be reason enough to buy above its high. Also, the bar has to be analyzed in context. If the bar is in a trading range, it would be foolish to buy above its high, because trading ranges tend to test the extremes repeatedly and you should not be buying near the high when the odds of the bar being a test are greater than the odds of the bar being a successful breakout. Similarly, a bear trend bar with a shaved bottom in a runaway bear trend is a setup to short at 1 tick below its low. When the market is quiet and the volume is low, shaved tops and bottoms are sometimes commandano to signal strength. We now see many shaved tops and bottoms in an hour or so and they are in a trading range. Be very selective about trading. Each of those bars is a trap, fooling traders into believing that there is strength when there is none. Not all small bars are good fade setups. There is one particular situation where they should not be used as signal bars, and that is when the bar is a small doji, small relative to the recent bars, especially if it has no body, it is near the moving average, and it occurs approximately between 10 a.m. and 11 a.m. Pacific Standard Time. These have a very high failure rate and always require more price action before placing a trade. Although most large trend bars that are with trend are strong, if a bar is unusually large, it often represents a climactic exhaustion, a buy climax. For example, in a bull trend, it often means that the last buyers bought and they bought in a panic because they just had to get an 80 price. If they were short, they just had to buy back their losing shorts at any price. If there are no more buyers, the market will go down. Any standard reversal setup can serve as a signal bar, but a second entry with a strong reversal bar is always the safest setup when trading countertrend. Big trend bars on breakouts often fail on the next bar, trapping traders into the wrong side of the market. This is especially common on quiet trading range days, when the market is always surging to the top and bottom of the range and fooling NAIV traders into expecting a successful breakout. Figure 6.1. Signal bars, other types. 111. Figure 6.1 Small signal bars. A Small bar can be a with trend or counter trend setup. In a trend, a small bar on a pullback is only a with trend setup. As shown in figure 6.1, bars 7, 9, 12, 14, 17, and 21 where small bars in pullbacks and the only trade offered was a shorten stop at one tick below their lows. Even though they were mostly doji bars, they were with trend and therefore reasonable shorts. Most signal bars in a strong trend look weak, and that is one of the reasons why the trend just keeps working lower. Bears are eager to short and bulls want to exit with a smaller loss, and both keep waiting for a strong sell setup. This would make them confident that the market is not going to rally and that they need to get out immediately. The perfect setup never comes, and the bears are trapped out and the bulls are trapped in. This creates a constant sense of tension and urgency that keeps driving the market down. Both keep selling in small pieces all day long, just in case the perfect setup never comes. And it usually doesn't. The setups never look strong, so it is easy for traders to assume that the trend is weak and that there will soon be a good rally that will allow them to sell at a better price. They see the market staying below the moving average, but it never falls fast enough to make them panic, so they keep hoping for a bigger rally to sell. The weak signal bars are an important ingredient in strong trends. A small bar can also set up a counter-trend trade against a trend if it occurs at a swing low, and there are other reasons for trading counter-trend, like a prior trend line break. Bar 16 was a small bear bar that set up along after a break above 112. Price action. Figure 6.1. The bear trend line and the high 4 bottom of the bear channel from bars 7 to 13. There was a two-legged pullback from the bar 14 test of the moving average, and the market was likely to have a second leg up.